Hi, today we're going to be looking at the due diligence in capital markets. In capital markets, long-term debt, equities, and securities are bought and sold. Through this mechanism, the money of savers, which are held by financial institutions, is put to long-term productive use by companies or governments. There are regulators who oversee how these markets are operating and the institutions who are investing their ultimate beneficiaries' money in these capital markets. There are both primary and secondary capital markets. In the primary markets, new share issues or bonds are sold to asset owners or institutions holding the money of investors and savers. In the secondary market, existing bonds or equities are sold among traders or investors. A secondary market is important because it encourages investments into primary markets. This is so because the initial capital market investor knows that it is able to sell the equities or bonds acquired by it if circumstances call for such disposal. In the acquisition of shares, the members of the capital market will acquire the equity in the companies who have issued those shares, whereas acquiring a bond issued by a company, the capital market investor becomes a creditor of the company. It will be seen that companies in raising money have to make a decision whether they are going to do so by way of equity or bonds. If by equity, then the company's debt is not increased. From the investor's perspective, a bond is less risky because it will rank ahead of shares on bankruptcy. On the other hand, the share could give the investor a higher return by way of an increase in the share price and increasing dividends. Usually, when a company issues a bond with a particular coupon, the financial institutions in capital market bid for the bond. The successful bidder obviously acquires the bond and becomes a creditor of the company. In acquiring either shares or bonds issued by a company, the financial institution in the capital market owes a duty of care to its ultimate beneficiaries to ensure that it does a due diligence on the company and that it is going to not only survive but thrive, at least for the duration of the bond. Or in the case of equity, it may be an investment by a pension fund, and the intention may be to dispose of it in the long term. There is a realization in the world that we are in, a resource-constrained one, but with increasing population. At present, we have approximately 7.4 billion people on the planet, and by 2045, the estimate is that we will have another 2 billion people on the planet. It is clear that there will be an increased demand for product, but with declining natural assets which have been used faster than nature has been regenerating them. Consequently, to carry on business as usual is no longer an option. The consequence has been to change the mindset of the boards of companies to create a business model which will have positive impact on the three critical dimensions of sustainable development, namely the economy, society, and the environment. One of the drivers of an integrated approach to strategy and reporting has been responsible investment. Responsible investment requires institutions to inquire as to whether a company has done an integrated report. If not, why haven't they? Has it done a sustainability report? If not, why not? Has it got a supply chain code of conduct? Has that supply chain been monitored? Does the company know what is happening in its supply chain? The reason for all this is that asset owners have learned that a financial due diligence can be done on a company before investing in its equity or its bonds, but something can happen to one of its intangible assets, for example, reputation, or in the supply chain, such as the use of child labor, which can destroy up to 60% of value on a stock exchange within a few days. Consequently, financial institutions in capital markets, before investing their ultimate beneficiaries' money in either an equity or bond issue by a company, today have to do a completely different due diligence. They have to inquire as to the nature of the company's business model. Is it one that will have a positive impact on the three dimensions of sustainable development? If not, what is the value creation strategy of the company to endeavor or eradicate the negative impacts on those three critical dimensions, particularly societal and environmental? A financial due diligence is well known, but a due diligence in the long-term value creation business model of a company has to indicate that it is one which is sustainable in a resource-constrained world. It is in this context that the IIRC was formed once it was accepted by the great standard setters and reporting institutions that the financial reporting alone was not sufficient. In conclusion, the institution participating in capital markets transactions involving company shares or bonds have to increase great care in their due diligence before investing their ultimate beneficiaries' money. It drives the board to think of the 6 capitals: financial, manufactured, human, natural, intellectual, and societal, which includes the relationship between the company and its stakeholders in creating that business model. Financial institutions and capital markets may well need people other than auditors to assist them in doing a due diligence which covers all the risks associated with the intangible assets making up to 80% of a company's market's value before investing their beneficiaries' money in the company's equity or bonds. Thank you for watching, and see you next time.